Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, May 20th, 2023. And our top story today, the stock market is sending so many mixed signals. And joining me now to discuss this and a lot more, Jane King is a financial journalist joining us from the NASDAQ. Jane, great to see you as always. Thanks so much for joining us on the program this morning.
Oh, thanks. Great to be back with you, Jeffrey.
Yeah, it's great. And this is kind of a newer segment for BRN. And let's wrap up the markets this week. And I want to ask you, there's so many mixed signals here, Jane. We've got all this talk about the debt ceiling. What's your initial reaction to what the markets are kind of doing?
Well, what I hear from the people I talk to is that they think there's going to be a resolution. I mean, we've been here before. They always take it to the wire, which in itself can be a little disruptive to the economy. But I think both sides recognize just how traumatic this would be for the US economy, for the global economy. And so they'll reach something. It'll probably go down to the wire, but it does feel like progress is being made. And Wall Street isn't super worried about it, but they're definitely keeping an eye on it.
Yeah, as you said, I mean, this is not new. I mean, for those who are watching, this is like deja vu. I feel like we're in a ping pong match or a tennis match, right? And back and forth, Kevin McCarthy to President Biden. But how are the markets? You said the markets kind of calm, cool, collected. How do they do this week?
Yeah, well, we're a little bit higher today on a Friday morning. We do have the Federal Reserve Chairman, so we'll see how we actually close. But we had, that big day, that 400-point gain. But other than that, kind of lackluster. I feel like we've been in the doldrums. I mean, you know the saying, Jeffrey, sell in May and go away. And maybe that was a good saying this year. We'll see. Bank of America was out this morning with a note recommending that people sell U.S. stocks. They think that interest rates will continue to go up and that we're in kind of a mini bubble, especially in tech. The NASDAQ's up 17-18% or something this year. So there's just some negative comments going into the market. And the summer does tend to be negative mostly. Now, you can never say that every year, but it does seem like, July, August, we get in kind of those dog days of summer. But it's been kind of a lackluster week, and we'll see what happens, I guess, when we come back on Monday.
Yeah, Jane, I always thought the saying was April showers bring May flowers. What do May flowers bring? Pilgrims. Right. All right. So, but okay, that was dumb. I'm going to get a lot of hate mail on that one. Jane, I was looking at some numbers. The S&P 500 has, I think, returned double-digit returns. So that's an index that, for those that are watching, it's an index that tracks the 500, I guess, largest companies, and pretty static, but it's returned double digits for 8 of the last 11 years. That is pretty impressive.
It is. I mean, and people are a little nervous about, putting their money in the stock market, but over time, it is the best place to have it. I mean, it just shows that year after year after year. I mean, you have a down year like we did last year, but, if you've got, 10 years or more, it's just about, you can't find returns like that anywhere else besides the S&P 500. And you don't have to pay all those extra fees when you invest in the S&P 500. You just buy an index fund and take advantage of that. So it's really, when people ask me how to start, I tell them start with the S&P 500 index fund, and then kind of, go from there once you feel comfortable.
Yeah, I'm a big fan of the slow and steady wins the race. And I always like the turtle over the hare in the tortoise and the hare story. Jane, you bring up the market, and Gallup had a recent poll that people were just like Debbie Downer negative on the stock market. And I wonder how much of that is like what they watched. So if they're watching like a certain station or they're reading a certain newspaper, does that kind of play into their, or just the short-termism that we always hear about? Because we're talking about long-term investing. Well, I mean, maybe not just you, but me, in terms of retirement. And I wonder how much of that frames that negativity that Gallup reports.
Well, we know bad news sells. So you always have to keep that in perspective when you're watching the news. And another thing that happens in the market is the market tends to do, and I think we've talked about this before, it tends to make the biggest fools out of most people or something like that. So if you start hearing a lot of people being one way or the other, either really positive or really negative, that's usually a time to kind of take the opposite position, because they piled on. I mean, there's so much negativity that a little bit of a bounce is probably what's next. And that's what we saw at the beginning of the year. It's kind of slowed down a little bit, but yeah, I think you got to kind of do your own research. And again, I mean, if you're new to this S&P 500 index, a great place to be. It's super broad. So you get, retail and manufacturing and tech and, you get exposed to everything. It's 500 stocks. You're not overly exposed into just one. It's not too risky. I mean, it's just a really good, safe place to be for retirement.
Yeah, I echo your sentiments. And look, I mean, you're right. Bad news sells, but I think good news also lifts people up, or just the facts. And that's what we're going to do. That's what you do. That's what we do here on the network. Jane, we're going to have to leave it there. Always great to see you. Thanks so much for joining us. We look forward to having you back on the program again next week. Thanks, Jane. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. This week we tried to make sense of all the market events in 2023 as we broke it all down for long-term retirement investors. Let's take a look.
Well, we're clearly in a transition. We went through a really extraordinary set of circumstances with the pandemic, and that meant not just monetary stimulus coming from the government, but fiscal stimulus and massive amounts of it. And the United States wasn't alone. Other major developed countries went through the same experience in terms of pumping a lot of stimulus into the economy to compensate really for the traumatic shutdowns created by the pandemic. It's natural to then see this enormous surge in inflation when economies reopened. There was a lot of money out there chasing very few goods and services, relatively speaking. And really the definition of inflation is too much money chasing too few goods, or at least the simple definition of inflation is that. So then, of course, we saw central banks react to that high level of inflation, maybe waiting a little too long and then getting extremely aggressive. And so we've seen just a massive amount of tightening on the part of many central banks over the last 14 or so months. And so here we are today in an environment where rates have gone up dramatically. I think I have whiplash from the amount of aggressive rate hikes we've seen. We also have an economy that is clearly slowing as a result of those aggressive rate hikes, but we also have an unusual set of circumstances in terms of the labor market, where we've really had shortages in a number of different industries. So the labor market remains tight. Now, that is, to me, an economy that is poised to continue slowing down. We're likely to see some weakness in employment going forward. That's certainly the aim of the Fed. We're likely to continue to see a slowdown. And at a certain point, because I do believe that central banks, especially the Fed, are going to pause. In my opinion, the Fed has already initiated a de facto conditional pause. So what we're likely to look out on is this downturn that then is followed by a recovery. So for retirement investors, they tend to have a longer time horizon. Even those who are in retirement are likely to live much longer. And so they don't have to worry about where we are in the economic cycle today. What they do need to understand, though, is that what has happened with rate hikes has created a far different and far better environment for fixed income than they've seen in many years. And so in some ways, the picture is better for retirees because income yield is more abundant. Well, it really doesn't change anything we do, but it does create a better environment just because income is more abundant. But the reality is that what we're doing is looking for the most attractive securities in a given portfolio, given that mandate. I think the bigger picture, though, is that this is an environment in which we're no longer in what has been termed TINA. There is no alternative. And that, of course, was referring to equities. Now, fixed income is a lot more attractive. It's a lot more competitive relative to equities. And I think that many investors are going to be much happier with a diversified portfolio, with adequate exposure to fixed income as well as equities than they have been in years because of this abundant yield environment. Inverted yield curve is a great, rather accurate signal for whether or not an economy is going to go into recession. Now, there are different segments on the yield curve, but the one that is probably most followed is the 2s, 10s yield curve. And that is the 2-year bond and the 10-year government bond. And in a normal environment in which we anticipate an economic expansion, what we would see is that the 2-year yield would be significantly lower than the 10-year yield. That is a normal yield curve. But when a yield curve gets inverted, when the 2-year yield becomes higher than the 10-year yield, that is signaling trouble in an economy because the assumption is that further out, growth will be lower, and that's why the yield on the 10-year is lower than the 2-year. So in that environment, investors become cautious, and with good reason, right? Because it has been so predictive historically. Now, if you look at some of the Fed research, they would argue there are different yield curves to look at, the 3-month, 10-year, but all of these yield curves really are signaling that we are going into an economic downturn. We're likely going to see a recession. Now, what does that mean for retirement investors? Well, I don't think it means too much for them. Again, I think the most important thing is that yields have gone up significantly, that overall the yield curve has moved up, and that's important. What we're likely to see, of course, in what markets are anticipating is that at some point, the short end of the curve will come down, that we are likely to see the Fed cut rates at some point because it has driven the economy into a downturn. Or, the alternate scenario is that it is comfortable enough with the progress of inflation that has gotten that the disinflationary trend has taken hold and inflation has gotten low enough that it can cut rates. So at some point, we would anticipate that rates on the short end would come down. We would go back at some point to a normal yield curve. But for the purposes of investors, I think for retirement and retirees, for retirement investors, really the key takeaway is that we are in a higher yield environment. And that's really important because we haven't seen that in years and years.
Next up, we discussed the surprising robust jobs report and what does it all mean for employers and job applicants. Let's take a look.
So my first reaction is that this is really quite incredible. The jobs report beat expectations for the 13th time in a row. We have been sort of waiting for a recession here in the United States since the beginning of 2022. So while the recession watch continues and people are sort of with bated breath anticipating something to break, the labor market has not broken. Job gains are still very, very robust. We're adding over 100,000 more jobs each month than is needed to keep up with population growth. That means that the unemployment rate keeps sort of getting lower and lower. It's at a 70-year low right now. And we're seeing gains for groups that often struggle most in the labor market. So young people and minorities are seeing some of the lowest unemployment rates in decades. There's an indicator that the labor economist sort of coined called the labor leverage ratio. And that's basically the ratio of quits, the number of people quitting their jobs voluntarily, and the number of people being laid off involuntarily. And right now, that's still better than it was before the pandemic, but it ranges dramatically across the economy. In the last year, it has actually fallen 60% in the information sector. And so the tables have been turned quite dramatically in an industry where workers were commanding extremely attractive offers and could sort of name their price. That's no longer the case. In healthcare, it hasn't declined at all. In fact, it's still getting better for workers. And in arts and entertainment, we have that sort of record highest number of job openings ever, and workers are still in very high demand. The Labor Department's questions are hard for survey takers to interpret. When people are asked, "Are you a contractor?" they think you mean, a builder, and they say no. If they're asked, "Are you a gig worker?" they think you mean someone with a trumpet at a bar, and they say no. And so economists have actually rewritten the surveys and asked the same questions, but with follow-ups and sort of with deeper questions. And they find that probably twice as many workers are contractors or gig workers as the official statistics suggest. And that means we actually don't know what's happened to those statistics over time. We don't know what the current trend is. Just that this is a pretty large share of the population, about 15% of workers. And that those roles often have a lot of benefits in terms of flexibility, but they lack real benefits, employee benefits and security. And so what we are seeing in the jobs report is that there are more people holding multiple jobs right now, but that's a very cyclical trend. Whenever the economy is good, when the job market is good, the people who want to hold multiple jobs can find multiple jobs. It's more about opportunity typically than it is about necessity. So Black unemployment is the lowest it's ever been right now. We've now had an unemployment rate overall below 4% for 15 months. And 4% seems to be kind of a magical tipping point. When the unemployment rate is that low, employers have to get really creative to get butts in seats, excuse my language. They have to actually go out and recruit people. They have to go and persuade people. They can't be quite as discriminating as they would normally be. They have to relax requirements for roles and invest more in training. If you can't find the workers you need, you've got to kind of create and cultivate the workers you need by investing in them. And so that's what we're seeing. We're seeing requirements come down, investments in training and apprenticeships go up, and diversity sort of improve.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to? Drop us a line, and don't forget, for all the latest curated news, lifestyle, wellness, finance, tech, so much more and all in one place, check out today's edition of our daily newsletter, The Morning Post. Want to search our archives, check out our latest content, we'll visit our website, and of course, all of our streaming partners. We're back again tomorrow for another edition of BRN Sunday. we'll be joined by members of the media, academia, financial services, and government as we break down all the news and events for the week. You're not going to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Tax audits, tax liens, wage garnishments.
Every day we hear stories like this about good folks who are simply struggling to pay their bills. Each of them are living a frightening IRS tax nightmare, and they are afraid it will destroy their lives.
I'm a divorced single mom, and my ex-husband left me and the kids with a lot of unpaid bills, including unpaid taxes. I was really starting to show my stress on my kids because the IRS had sent me a letter demanding a huge payment from me. I couldn't afford it. So then the IRS was threatening to garnish my wages. I'm already living paycheck to paycheck. That would have put me over the edge financially.
It truly seemed hopeless, but then a friend at work told her to call the tax relief line.
The people at the tax relief line, they told me about something called innocent spouse relief. They worked it out so that all of the taxes from my ex are not my problem. I don't know how that works, and I don't care. All I care about is that I don't owe the IRS a dime, and they are not going to take my paycheck.
Even if it seems hopeless, you should call the number on your screen right now. There is absolutely no cost for the call or the consultation. You are under no obligation. If you are worried that the IRS could garnish your wages, seize your assets, even take your home, call us right now. The Tax Relief Line is here to help you. Now you have a knowledgeable, professional team of tax experts that are ready to negotiate with the IRS and fight for you to save you money. The Tax Relief Line's professionals have successfully negotiated thousands of cases, reducing and sometimes even eliminating the tax debt for their clients. It's very easy to get started. Simply call the number on your screen right now. You don't have to live in fear anymore. The call and the consultation are free.